Good morning, everyone. This is Marshall Gittler bringing you the morning comment for November 12th. The dollar's a little weaker today for no apparent reason, probably just a mean reversion during a U.S. holiday. The exception was, once again, the yen. Japanese stocks hit a 7-year high, and dollar yen moved up along with them on talk that the government may postpone its planned increase in the consumption tax and call a snap election as a referendum on the tax hike. The election could cement Prime Minister Abe's grip on power because no matter how unpopular he is, the opposition is even less popular. Meanwhile, the delay in hiking the tax is perceived as a positive for growth. Note, though, that a party official today denied that an early election is in the works, which took some of the steam out of dollar yen. But personally, I don't believe him. What else can he say? He can't confirm an election because that's the Prime Minister's role. So I think this pullback may offer a good entry point for dollar yen longs. Over the longer term, how high can dollar yen go? I don't have time to go into all the details yet, but just in sum, I'll point out for the last couple of decades, dollar yen has averaged 37% overvalued, according to the OECD's purchasing power parity methodology. So why can't it become 37% undervalued for a while? That would be dollar yen at 140. That would be a big overshoot, so being a little bit more conservative, I think yen 130 is quite achievable. Meanwhile, the New Zealand dollar made the biggest gains overnight, even though the Reserve Bank of New Zealand Financial Stability Report repeated their recent mantra that the Kiwi is still above sustainable and justifiable levels and could drop further. The reason for the strength was probably that they also said interest rates may need to rise again in coming years as there's a risk of a resurgence in house price inflation. Well, I think both the Kiwi and the Aussie are liable to suffer from reduced Chinese demand in coming months. I prefer the Kiwi over the Aussie because, first off, I expect demand for agricultural commodities to be stronger than demand for industrial commodities. And secondly, I think the RBNZ is likely to hike rates again before the RBA, before the Australian Central Bank starts on its hiking cycle. Now, during the European day today, the UK will take center stage. The nation's employment rate for September is expected to decline to 5.9% from 6%, and average weekly earnings are anticipated to rise. So this suggests less slack in the labor market, and therefore a possible earlier hike in interest rates. At the same time, we also get the Bank of England inflation report with new forecasts for growth and inflation. These are likely to be revised down. So there's lots of opportunities for volatility, depending on which announcement the market pays more attention to. Personally, I think the labor market data remains crucial, and I'd focus on that. If the data comes as expected, it's my view that the pound could strengthen. Eurozone industrial production for September is forecast to rebound on a monthly basis, but after the recent poor data for the Eurozone, I think a rebound probably won't be enough to reverse the negative sentiment towards the euro. Nothing major coming out of the US today. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, Head of Global FX Strategy at IronFX Global, wishing you solid trading.